This final part, I will walk through Wells Fargo's SWOT analysis, financial performance, and give my single recommendation for the company moving forward. This SWOT analysis gives a complete picture of where Wells Fargo stands today, starting with the strengths. Wells Fargo still has one of the largest national footprints in the banking industry. Their huge customer base and well-known brand gives them a competitive advantage that many smaller banks simply don't have. They also offer a very broad range of financial products: checking and savings accounts, mortgages, personal loans, business loans, wealth management, and investment services, which means they can earn revenue from a lot of different sources. And even though Wells Fargo has faced issues financially, they still have strong resources and the ability to invest in technology and improvement. Now, looking at the weaknesses, the biggest one is the long-lasting damage to their reputation from the scandals that started in 2016. Even though some time has passed, many customers still remember it, which makes trust harder to rebuild. Another weakness is the amount of regulatory oversight they still deal with. Restrictions placed on the company limit their ability to grow as fast as other banks. Customer trust has also been lower than competitors, which hurts things like new account openings and customer loyalty. And lastly, Wells Fargo consistently pays high legal and compliance costs because of its past issues, which affects how much money they can invest in innovation. Moving into opportunities, Wells Fargo has a big chance to grow through digital banking. Customers today expect fast, easy online banking and mobile app features, so improving this could attract younger customers and bring back people who left. The company also has the opportunity to use AI and automation to modernize fraud prevention, customer service, and loan decision tools. Another opportunity is the growth in sustainable finance and environmentally responsible investment products, which many customers and businesses are now seeking. And finally, Wells Fargo could expand more into global markets or strengthen its presence in areas where it underperforms. The threats section shows some of the bigger challenges. Wells Fargo faces fintech companies like PayPal, Cash App, and digital-only banks are taking away customers, especially younger ones who prefer digital-first services. Cybersecurity threats are also a major concern for all banks, and one serious breach could do major damage. Economic uncertainty, like interest rate changes or a recession, could also affect loan performance and profitability. And lastly, Wells Fargo is still under heavy regulatory pressure. If they don't continue improving compliance, they could face new fines or additional restrictions. Overall, this SWOT analysis shows that Wells Fargo does have strong resources and real opportunities, but its long-term success depends heavily on fixing reputation issues, strengthening compliance, and moving aggressively into digital banking and AI-based solutions. These insights help shape the recommendation I'll present later for the company's future direction. Now let's take a closer look at Wells Fargo's financial performance over the most recent reporting period. Overall, the company shows signs of stability with a mix of strengths and areas that still need improvement. Revenue showed slight growth year over year, which tells us that Wells Fargo is gradually increasing its ability to bring in money despite competitive pressures. This growth isn't dramatic, but in banking, even small increases can reflect stronger lending activity, higher interest income, or improvements in fee-based services. It shows that despite the company's challenges, customer demand and core banking activity remains steady. However, when we look at operating profit, we see a mild decline. This usually means that the bank's internal costs, such as salaries, compliance-related expenses, and technology upgrades, are rising faster than revenue. A decline in operating profit is a sign that this company may need to improve efficiency, manage costs better, or streamline its operations. It doesn't necessarily indicate financial trouble, but it highlights an area where Wells Fargo could strengthen its performance. What's important is that the decline is mild, not severe, which means it's manageable if the company continues improving its processes. On the positive side, net income, which is the bottom line profit after all expenses, actually increased. This is a very good sign because even though operating profit dipped, the company still managed to convert more of its revenue into actual profit. This could be the result of lower loan losses, better interest spreads, or reduction in certain non-operating costs. It tells us that Wells Fargo is still capable of generating still solid earnings and that the core business remains profitable. Looking at the balance sheet, both total assets and total liabilities stayed relatively stable in in banking. Stability is often a strength because massive swings can indicate risky lending behavior or sudden deposit withdrawals. Stable assets and liabilities tell us that Wells Fargo is maintaining a consistent loan portfolio and steady customer deposits. It also signals that the bank is not taking large speculative risks, which is exactly what regulators want to see from Wells Fargo moving forward. We look at the cash levels. End of year cash decreased slightly, which could mean the company has been reinvesting funds into operations, technology improvements, or regulatory compliance. A small decline in cash is not necessarily negative. Often it reflects strategic spending intended to support long-term growth. As long as the decline is controlled and the company maintains strong liquidity elsewhere, a dip in cash can be part of a normal strategic cycle. Overall, the financial performance section shows that Wells Fargo is on stable ground. There are areas that need work, especially cost efficiency and operating performance, but the company is maintaining profitability, keeping its balance sheet stable, and making a strategic investment. This financial foundation plays an important role as we move toward the recommendation for how Wells Fargo should move forward in today's competitive banking environment. Now I'm going to walk through the key financial ratios which help us understand Wells Fargo's performance in a clearer and more meaningful way than just looking at raw numbers. Ratios are important because they allow us to compare the company's performance year to year and also against other banks in the industry. Current ratio. The first ratio is the current ratio. Wells Fargo's current ratio is around 0.29, which might look extremely low compared to a normal business, but for a bank, this is completely normal and not a cause for concern. Unlike retail or manufacturing companies, banks operate under a different structure. Their main current liabilities are deposits, and deposits can be withdrawn at any time. Meanwhile, their current assets are cash, short-term investments, and loans. So a low current ratio doesn't mean the bank is struggling. Instead, it reflects the nature of the banking industry where deposits fund loans. Regulators care more about liquidity, coverage ratios, and capital levels than the traditional current ratio. So in Wells Fargo's case, this low number is expected and normal. Next is the graph excuse me. Next is the gross profit margin, which for Wells Fargo is around 48%. For a bank, this isn't a traditional margin like you would see in retail or manufacturing. Instead, this margin reflects how much revenue remains after subtracting interest expenses, which are the cost of borrowing money. In Wells Fargo's case, interest expenses are increased recently because interest rates in the economy rose. When interest rates rise, banks have to pay more to customers on savings account and other deposits. So even if total revenue stays steady, the cost side increases. That's why the gross margin went down slightly. This ratio tells us that Wells Fargo is feeling pressure from rising funding costs and the bank needs to keep improving efficiency to maintain strong margins. The net profit margin. The net profit margin is about 24%, which is actually a strong margin for a large bank. This ratio shows how much of its revenue Wells Fargo keeps as a profit after all expenses, even though the gross margin was squeezed by higher interest rates. Wells Fargo still managed to increase its net profit margin. This suggests that the company is doing a good job controlling their costs, such as operating expenses, loan losses, and overhead. It also shows that the bank's core business remains profitable and resilient despite economic pressure and competitive challenges. A rising net profit margin is a positive indicator that the company is managing its operations more effectively. Overall, together, these ratios show us a few things. Wells Fargo's business model is still stable even with interest rate challenges. The bank is maintaining profitability and financial strength at the bottom line despite pressure on gross margins, and although the current ratio appears weak, at first glance it's completely normal for banking and not a sign of financial trouble. The ratio suggests that Wells Fargo is financially healthy but needs to continue improving efficiency and investing in smarter technology to stay competitive. For my recommendation, I am suggesting that Wells Fargo create what I call a digital trust and compliance center, which will be a centralized, technology-driven system focused on restoring customer trust, improving compliance, and strengthening digital banking. This recommendation is based directly on the weaknesses, threats, and financial trends revealed in the earlier parts of the analysis. Why this recommendation is needed. Wells Fargo's biggest long-term challenge is trust. Not technology, not competition, but trust. The 2016 account scandal had a lasting impact on customer confidence and triggered years of regulatory restrictions. Even though the company has made progress, many customers still associate Wells Fargo with that event. At the same time, fintech competitors and digital-only banks are growing quickly because they offer fast, transparent, and technology-driven experience. Wells Fargo needs a solution that addresses both issues at the same time. They must rebuild trust and strengthen their digital presence. What the Digital Trust and Compliance Center includes. It includes would be several important improvements together in one coordinated effort. First, it would include an AI-driven fraud monitoring system that can identify unusual account activity instantly and prevent fraud openings or suspicious transactions. This helps avoid future compliance problems and protects customers in real time. Second, it would include a customer transparency hub where customers could track the status of disputes, complaints, or account reviews. This level of transparency would go a long way toward rebuilding customer trust. Third, the center would also integrate a personalized digital banking experience using AI to make the apps simpler, more intuitive, and more supportive for customers' financial needs. This gives Wells Fargo a complete competitive edge against digital-only banks. From a financial standpoint, this recommendation supports both long-term profit growth and cost reduction. A stronger compliance system would reduce the risk of future fines, lawsuits, and remediation expenses, which have cost the company billions over the last decade. A modern digital system also lowers operating costs by reducing manual processing and improving efficiency. At the same time, better digital services would attract younger customers, increase customer retention, and boost fee-based revenue through increased digital activity. This means the investment supports both stability and growth. The reason this is the best strategic direction is because it directly targets Wells Fargo's biggest weakness, reputation and regulatory issues, while also supporting the biggest opportunities, digital banking and AI adoption. It is focused, actionable, and achievable with the company's existing financial resources. Most importantly, it positions Wells Fargo to compete not just as a traditional bank, but as a modern technology-driven financial institution that customers can trust again. Overall, the Digital Trust and Compliance Center would help Wells Fargo solve its most damaging problems while setting the foundations for long-term digital success. It's a strategic investment that supports trust, compliance, customer satisfaction, and future profitability all at the same time. In closing, Wells Fargo's future will depend on how effectively they rebuild customer trust and adopt smarter technologies. If they execute this strategy well, they can regain their position as a leading U.S. bank.